All right, so the S&P 500 finally lost some steam today.
Yeah, that 4-day winning streak is over.
Snapped. It was down 0.35%, closing out the session at 6,846.51.
And you can really feel the market getting nervous as we get closer to this final Fed meeting of 2025.
Oh, absolutely. And you can see that nervousness really clearly in the volatility markets.
Right. The VIX, the market's main fear gauge, it just woke up, surged 8.11% to hit 16.66.
And that's the biggest volatility spike we've seen in weeks, isn't it?
It is, and it's screaming one thing. People are positioning themselves before the announcement. It's fully underway.
Okay, so let's try to unpack this because there's a huge contradiction here. This isn't really about if the Fed cuts rates.
No, not at all. That 25 basis point cut has an 88% probability priced in. It's practically a done deal.
The anxiety is all about the guidance for 2026. The potential for what everyone is calling a hawkish cut.
That's it. That's the whole game right now. Why is the market hedging against disappointment when a cut seems guaranteed?
And the most confusing piece of that puzzle today, for me, came from fixed income.
Oh, definitely.
So help me make sense of this because the paradox is just glaring. We had Treasury yields rising across the entire curve.
Right. Even though we're almost certain to get a cut on Wednesday, the 10-year yield was up 3 basis points to 4.170%.
And the 5-year saw the biggest move.
The biggest move, yeah. It rose 4 basis points to 3.750%.
So why on earth are people selling bonds if easing is right around the corner? It goes against the playbook. What is the bond market telling us?
It's sending a very, very cautious message. And I think it boils down to, 3 related concerns about the future cost of duration.
Okay.
First, and this is the most immediate one, traders are betting the Fed's new dot plot is going to show fewer rate cuts next year than what the market's pricing in.
Which is currently, what, 3 to 4 cuts?
Exactly. So that's your core hawkish cut fear right there.
And the second concern,
That's more structural. The term premium is expanding.
right, the extra compensation investors demand for holding longer-term bonds because of, say, inflation or government debt risk.
Precisely. And today's increase suggests investors are now explicitly baking in a long-term fiscal risk premium. It's a real shift.
So the bond market's message is that the price for future cuts is just higher now. Long-term risks are outweighing that short-term certainty.
That's a great way to put it. And the third piece is just global pressure. There's a lot of focus on the Bank of Japan again.
The idea that they might finally be pivoting away from that ultra-loose policy.
Right. And when a major foreign central bank even hints at tightening, U.S. markets feel that pressure.
But here's where it gets interesting for me. Despite all that yield pressure, the curve structure itself still looks pretty healthy.
It does, which suggests confidence in a soft landing hasn't just evaporated.
Exactly. I mean, if this were a true panic, we'd expect a sharp inversion.
We would. But instead, the 30-year minus 10-year spread is still positive at 65 basis points.
So the market expects things to cool off, but not enough to cause recession. It's a big change from the deep inversions we saw a year ago.
It is. And just quickly on corporate debt, we saw a similar risk-off tilt. Investment-grade bonds, the LQD, fell 0.21%.
And high-yield HYG was down a bit more.
A bit more, yeah. Down 0.25%. So that gives you a slight negative spread proxy of minus 0.04%. Just modest stress, a small flight to quality.
Okay, so let's move into equities because the sector performance was highly unusual today, especially for a day driven by Fed policy fears.
Very unusual. Technology was the only sector in the green. It managed to climb 0.70%, while everything else basically fell.
And you have this huge contrast between that tech strength and weakness pretty much everywhere else. Consumer discretionary got hit the hardest, down 1.45%.
Right behind it, materials down 1.38%, and then utilities dropping 1.34%.
So that's a 2.15 percentage point spread between the best and worst sectors.
Which is a striking divergence. It tells you the market is making a huge distinction between those mega-cap tech companies with fortress balance sheets and, well, everything else.
Let's circle back to that VIX surge we mentioned at the top. It jumped 8.11%. That sounds like a big panic number.
It sounds big, but the underlying data suggests this was more of a surgical hedge. It's targeted specifically at the Fed's guidance, not some full-blown market panic.
So explain that distinction.
Well, even though the VIX did hit an intraday high of 17.09, which is a 3-week high,
Okay.
it's still trading almost 10% below its 50-day moving average of 18.49.
So people are buying insurance for the meeting, but they aren't running for the exits just yet.
Exactly. It's a targeted purchase, not a stampede.
I think the most telling anomaly today, though, was in small caps. The Russell 2000 closed basically flat.
Down just 0.02%. It massively outperformed the S&P 500's drop.
And that positive spread of, what, 0.33%? That feels like it's sending a very specific message.
It is. That's the classic signal that a rate cut, when it comes, is expected to help smaller, more rate-sensitive companies the most.
Because they're more levered to borrowing costs than the big tech giants.
Exactly. So their outperformance suggests the market believes this easing cycle will provide real relief to them, even if the Fed's language is a little hawkish.
And just to round out the indices, the Dow Jones Industrial Average had the steepest decline of the majors, falling 0.45%.
It did.
Okay, let's zoom in from the macro picture to some of the individual company movers. Because even with the broader caution, you had some truly explosive results.
Absolutely. The two big themes, GLP-1 drugs and AI infrastructure, they just keep delivering.
Let's start with the pharma space. Structure Therapeutics.
Ticker GPCR. It surged about 97%.
97%. Just incredible. That was a positive phase 2 data for its obesity drug, right?
That's right. That whole class of drugs just continues to rewrite the playbook for biotech. It's an unstoppable trend.
We also saw some big M&A speculation. Confluent jumped over 30%.
Yeah, on reports that IBM is in acquisition talks, the deal is rumored to be valued around $11 billion.
And then you have the index rebalancing moves. Carvana gained a solid 8 to 10%.
That was on its confirmed inclusion in the S&P 500, which will be effective December 22nd.
And on the flip side of that, Marvell Technology fell 6% after it wasn't included.
Right. Index disappointment can be just as powerful. And we also saw Tesla decline nearly 4% today, though there wasn't a specific catalyst noted for that move.
Okay, let's tie this back to rates and look at real estate. The REIT indices were down, which you'd expect with Treasury yields rising.
For sure. The main Vanguard ETF, VNQ, fell 0.77%. But inside the sector, there was a fascinating divergence.
This is that AI theme again, isn't it? Bleeding into other parts of the market.
It is. American Tower, ticker AMT, which owns cell towers and data centers, completely bucked the trend. It was up 2.43%.
So the demand for AI infrastructure is basically decoupling these specific REITs from the interest rate sensitivity that hits, say, residential or commercial real estate.
That's exactly what's happening, and the broader housing market really highlights that struggle. The 30-year fixed mortgage rate is ticking up again, near 6.28%.
And that's just keeping a lid on everything. Housing turnover is still at a multi-decade low of 2.8%.
Just completely suppressed.
So we've covered the U.S. positioning, but let's shift gears and look at the global markets because there was some really dramatic volatility in currencies.
Yeah, the moves there were huge. The biggest one was in the Brazilian real.
What happened there?
The USDBRL plunged 2.27% against the dollar. Fiscal concerns in Brazil are just intensifying.
And that move puts the real among the worst performing emerging market currencies for the year.
It does. It's a good reminder that high interest rates don't protect you if the market questions your policy credibility.
And in the G10, it was all about the Japanese yen.
All about the yen, yeah. USDJPY surged 0.52% to 155.94.
And that level is significant because it's crossing into that territory where Japanese authorities have threatened to intervene.
It is. They're on high alert, and you can see the market bracing for it. 1-week volatility options for USDJPY are pricing at 14.5%, the highest we've seen since December of last year.
Wow. Okay, so from currencies to commodities, where we saw some sharp reversals.
Especially in energy, after its recent run, natural gas collapsed 8.11% to $4.86.
That wipes out a lot of the recent gains.
It does, but it's important to note the price is still more than 22% above its 50-day moving average. So this feels more like profit-taking than a fundamental shift.
And WTI crude fell as well.
Down 2.03% to $58.86.
The moves in agricultural commodities were also pretty extreme. Coffee, for instance.
Coffee plunged a stunning 9.43% to $367.95.
And that was driven by tariff talk.
Exactly. Ongoing expectations of tariff relief from the incoming administration, which traders think will increase supply.
But on the other side of that, you had cotton surging.
Up 3.48% on sector rotation, a real study in extremes.
I think the split we saw in metals really reinforces that soft landing idea we talked about with the bond curve.
I agree completely. Gold slipped 0.26%, so less demand for a classic safe haven.
Right, but industrial metals were firm. Copper was up 0.76%. Aluminum up 0.91%.
And that divergent soft gold, firm industrial metals, it signals that the market is positioning for continued growth, not for some defensive risk-off crash.
Okay, before we wrap up, let's get a quick update on crypto.
Sure. Bitcoin is holding steady, trading at $91,123. That's up about 0.25% over 24 hours.
So it's consolidating after it dipped below 90,000 last week.
It is. Still about 27.96% below its all-time high of $126,080. But you're seeing relative strength in Ethereum. It's up 0.57% today and showing strong 14.82% gains for the week.
And Bitcoin dominance remains high.
Very high at 74.25%. Capital is still concentrated in the biggest asset.
All right, so let's bring this all back to the main event, Wednesday's FOMC meeting. Today's action just shows a market that's ready for the cut, but terrified of the commentary.
That's it perfectly. The entire market is trading one question. Does the new dot plot show 2 cuts in 2026, the hawkish scenario, or does it show the 3 to 4 that people are hoping for?
And today's trading action suggests what? A 50-50 shot.
Roughly a 50-50 probability of a hawkish cut, which explains all the cautious bond selling and equity hedging we saw.
So as people navigate the rest of the week, what are the key levels to watch?
For the S&P 500, the big one is support at 6,748.26. That's the 50-day moving average. A break below that would be a significant shift.
And on the currency side, keep an eye on USD/JPY.
A very close eye. That 156 to 160 range is the intervention watch zone. If it breaches that, we could see some sharp moves globally.
So to sum it all up, today was about risk management. It was about setting up for the biggest policy event of the year.
It was, and the message from the bond market is clear. The period of easy easing might be over. The Fed's going to need to see real economic weakness to justify more cuts in 2026, not just hope.
All right, I think that covers all the key action to the session. That's the daily consolidation for today.
And as always, this discussion is for informational and educational purposes only. None of it is financial advice, so make sure you do your own research before making any decisions.
Exactly. If you found this breakdown helpful, please subscribe or follow. We are here every trading day after the close with the full market summary.
We'll see you next time.